Okay, so when buying or selling options, having a clear exit strategy to begin with is always a good idea. Let's say, for example, you've purchased a deep, out-of-the-money call or put option. These options tend to have the most volatility. And with these options, it's not impossible that the contract will move 20, 50, or even 200% in a single trading session. And what if, for example, you're selling options? Let's say you're entering into a covered call strategy, and you sell a covered call option on a stock that you already own. Then the stock suddenly reports something positive, and it shoots up in price, and suddenly you're risking assignment. Have you considered the implications should your stocks get called away? Will you have, for example, to pay any capital gains tax? And are you happy about it? The same goes with selling cash-secured puts. Just a little bit of bad news, in one day is enough to send the stock crashing. And that could mean you're at risk of assignment if the option is now in the money. When it comes to taking profits in the options market, experienced traders usually attach orders to crystallize profits. For example, Interactive Brokers allows you to attach additional orders along with your trade. You could, for example, buy a call option and at the same time create a profit-taking order that will sell your option when it's worth 20, 30, or 50% more than what you originally paid for it. This way, the order will run at all times so that you don't have to keep watching it. And should the trade hit the desired level, well, you're going to crystallize your profits. And what about protection to the downside? Well, depending on the brokerage, you can also set up an additional order for that as well. For example, with the same call option, you could set a stop loss for 20, 30, or 50% lower than its current price. And if it hit that level, well, then it would get sold at that point. And of course, this type of order will have to be supported by the brokerage, and it should get placed at the same time as your initial order. You might also want to take a look into trailing stop limit orders. These are very advanced orders. But with a trailing stop limit order, you can set a limit on the maximum possible loss without setting a limit on the maximum possible gain. It's kind of like having your cake and eating it too. The limit order gets recalculated every second of the trading day based on the limit offset. So here's how it works. As the underlying securities price goes up, both the stop and the limit amount go up by the trailing amount and the limit offset. And should the stock price fall, the stop price remains unchanged. And when the stop price is hit, a limit order is then submitted at the last calculated limit price. As for me, my personal preference is to attach a profit-taking order of around 50% of my potential return. And depending on the trade, if I'm selling an option or a spread, for example, I might attach a stop loss around 25 to 50% of the maximum potential loss. Alright, so inflation, gas prices, employment, pandemic, and geopolitical issues, to name a few, are notorious for causing storms in the market. They cause all sorts of volatility, and the markets behave. Now, on one hand, option sellers love volatility because the premiums skyrocket. But skyrocketing premiums also means higher risk. And even if you're just a little risk adverse, consider a trade that doesn't place as many dollars at risk. Or even better, no one will mind if you take a little breather until the markets relax a little. Let's say you find yourself in a situation where you're facing a loss, but you still believe in the trade. And this is where rolling options can help. To roll an option, for instance, if you sold a call or you sold a put, It involves closing the trade and then re-entering a similar trade with the same underlying security, but perhaps a different strike price or even a different expiration a little further out. Let's say, for example, you sold a put option on Tesla. Tesla is a hugely volatile stock these days, and put option sellers can make quite a lot of money if they pick the right strike price. Let's say, for example, today Tesla trades for $1,084 and you're bullish on Tesla. So maybe you decide to sell a slightly out of the money put option expiring May 20th. Let's say you pick the $1,075 strike price that'll give you $88 in premium. That means you'll collect $8,800 for the trade in options premium. Now, fast forward a week. There's been bad news in the markets, and Tesla starts to move lower because of it. Well, anyone who's been in the market for more than 5 minutes has seen their positions tank just as quickly. But how do you fix it? Well, one thing you can do is close out your options contract by buying back the option you first sold. In this case, it would be the Tesla 1075 strike put option with the May 22nd expiration date. Now, you're going to have to pay a little bit more, most likely, in premium for the option than you initially received. This is because the stock price is lower. In this case, it'll now cost $96.50 to buy back the same option. But that's okay, because now what we're going to do is sell another Tesla put option, in this case with the same expiration date, but just with a lower strike price. So here I could pick the 1025 strike price and collect $68.19 for this option, which will help offset the loss from before. And in this case, our profit and loss is going to look like this. So we initially got $8,800 for the May 20th Tesla 1075 strike. To close out the trade, we bought the same put option back, now for $9,650. But now what we did is we sold the 1025 strike with the same expiration for $6,819. And our profit is $5,969. Now, no one says you had to sell the 1025 strike. You could be a little greedy and even sell the 1050 strike for more money. But no matter what you do, always think of the chances of profit before starting a trade. And doing so could mean less profits to begin with, but less problems down the line.